Do you keep wondering, is the stock market overvalued right now? And if so, how long has that gone on? And is it going to continue much longer? Well, if those are questions that you have, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. This video is part 2 to another video where I talk about the PE ratio, and the video is called, Is the Stock Market Getting Ready to Crash? Well, I recorded that about 6 months ago, and so as of August 1st, 2021, I wanted to give an update. Not much has changed, but yet some things have changed. In the video that I recorded 6 months ago, I said that I would be looking at this and giving updates as needed. Well, now I felt it was time to go ahead and give an update. I would suggest that each person goes back and watches that first video because I explain things in a little bit different way than I will here. So you might find that helpful. But when we're looking at overvaluation, undervaluation, and trying to come up with, is the stock market expensive or cheap? One of the things that we need to be aware of is that there are bulls, bears, and the clueless. These are pretty much the 3 different categories of market participants. People who have an opinion about the stock market usually fall into one of 3 categories. First are the bulls. They think the market is going to go up. And there are people that always think the market is going to go up. And they have good reason for that, because historically, the market, although it's had some downtimes, has generally gone up over the historical period. And I will show a chart of that later on to prove that case to you. Then you have people that are called the bears, and these are the doom and gloomers. They think the market is going down. There are some people that I follow. They have some useful information. Some of these people I've been following for over 20 years, and their outlook is always, we're going to crash. We're getting ready to turn. We're looking at things getting really nasty in the future. Okay, well, if you keep saying that long enough, eventually you'll be right, and then you'll be able to pat yourself on the back and say, look at me, wasn't I smart? Well, a lot of times when the perma bears are preaching that we're going down, these have been some of the biggest bull market moves that we have ever seen in our lifetime. Nonetheless, they still predict dark days ahead, and I don't know why that is. I guess it comes down to one's personality, and that if you're more of an optimist, you think things are going to go up. If you're more of a pessimist, you think things are going to go down. And then we have probably the majority of people who are clueless. They maybe read a book or took a 2-day class, or they watched some webinar, or they followed some videos on YouTube. They learned just enough to think they know what they're doing, but really they're clueless. And these are the people that we try to stay away from, but at the same time, we follow them because it's useful to do the opposite of what the clueless crowd is doing. Another word that is often used for this is the dumb money. The idea is to follow the smart money and do what they're doing, follow the dumb money and do the opposite of what they're doing. Now, when I say opposite, I don't mean a one-to-one relationship opposite. There are times when even the clueless are right for a period of time, but the majority of the time they're going to get in at exactly the wrong time, and then they're going to get out at exactly the wrong time because they're acting on emotions. They're not really applying a plan to the markets. So we look for when extreme emotions are registering either to the upside or to the downside, and then we look at preparing to do the opposite of what they're doing. We may not jump in right away, either way, but we just get ready to do so. For the most part, the stock market usually goes up. People who are positive about the future are called bullish. Then we have the bears. There are times when the stock market can have extended declines. Typically over the long period of time, a bull market can last for a very long time, a number of years, where a bear market is usually shorter in duration because people sell a lot faster and things decline quicker than they have a tendency to go up. Those who are negative about the future of the stock market are called bears. And those people that are always optimistic, we call perma bulls. Those who are always pessimistic are perma bears. So here's a chart. And if you look at this, yes, over the long period, this chart just goes back to 1990. If you got in right at 1990 and you're invested right now, you've done very, very well. It doesn't mean you haven't had some pain along the way. You can see by looking at this chart, there are really significant moves to the upside, but we also have some really big moves to the downside as well. However, overall, prices have gone up. The thing that we need to look at is, just because this happened in the past, does that mean this will always happen in the future? There are a lot of changes going on right now. There are complete economic policies that are being implemented that have never been really implemented to this extent in the U.S. Is that going to help prices go higher? Or will that eventually push prices lower? We're also just coming out of the COVID-19 lockdowns, and possibly there's talk as I record this of maybe another lockdown happening in the future. What's that going to do to the economy? What kinds of programs are going to be put into place? So we have to look at things not only in a historical context and say, yes, over the long term prices have gone up, but at some point with all of these changes, you have to wonder, is that going to help things or hurt things? When we're talking about valuations in the market, we have to talk about a thing called earnings. That's the basis of a company. You get into business to make money. Well, how do you make money? First, you have to have earnings. And then you use those earnings to pay off your expenses, and what's left over are profits. And there are different ways that you can report these earnings. Earnings are the fundamental core of what makes companies more valuable or less valuable. If a company is making more and more money, their stock price will go up. If a company is making less money, their stock price will go down. That only stands to reason. Publicly traded companies use a thing called GAAP, G-A-A-P, to report earnings. And GAAP means Generally Accepted Accounting Principles. Doesn't mean that these are all fair. Doesn't mean that they're all righteous. It's what the industry has accepted as being principles that everybody can live by. Sometimes there might be some creativeness going on in this as well. Some people really like using GAAP. Other people think, no, this is not a realistic approach. Regardless, it's what the markets use for the publicly traded companies that trade on the stock exchanges. GAAP requires what's called the accrual accounting method, which recognizes costs and expenses when they occur rather than when actual cash is received or paid out. So some company may have an expense that they might spend 10 years paying off, but since it happened right now, they can write it off right now. And that makes their earnings look either worse or better depending on the situation. There's also the matching principle of accrual accounting, which requires the companies match expenses with revenue recognition, recording both at the same time. When you have money coming in and you have money going out, there's more of a one-to-one relationship there. Now, I'm not an accountant, and I don't go into this too far in depth, but there are just different methods that are implemented. Whether they're right or wrong is not really what I'm trying to discuss. It's what is used, and it's the information that we are given, so we have to go with the information that we have. But earnings can have a real impact on stock prices. Many investors buy or sell stocks as earnings go up or down in a company, and that only makes sense. If a company started off and they're making more and more earnings over a period of time, that would be a good solid investment because they're showing earnings growth. If you're in an investment now and you're seeing earnings really start to slow down, if not decline, you may be less inclined to hang on to that investment. However, sometimes there can be a large and extended disconnect between earnings and stock prices. What happens when earnings are going up and stock prices are going up, but the two are getting really out of line with each other? That's what I want to focus on in this video. It can take months or even years for earnings to come in line with stock prices. Usually what happens is stock prices get ahead of earnings. When these measurements are far apart, something will need to change. But this can take time, sometimes years, for this to adjust. Either stock prices have to come down to justify the earnings, or earnings have to go up to justify the stock price. Something needs to change. And the environment that we're in right now, and have been in for quite a while now, is way out of line. We're really overextended. And I'll have some charts and some other information to show you what I'm talking about. One measure, and this is only one measure, and I'm not even a big fan of this measure, but a lot of investors use this. It's called the price-earnings ratio, or the PE ratio. It's one of the things that you learn if you read a book about investing or you take any classes and you want to come up with, well, is the stock price justified? Should it be higher? Should it be lower? Well, what they do is you base it relative to earnings, and you come up with a ratio. So one thing investors watch is whether stocks are considered to be expensive or cheap. Typically, investors will want to buy stocks that are considered cheap. We say, hey, they're on sale. And it doesn't necessarily mean a lower price. What they're looking at is the stock price in relation to the earnings. And they want to sell stocks that are considered expensive. That's the premise behind a thing called fundamental analysis, or FA. And I have other videos that talk about that. You want to buy stocks that are considered to be undervalued, and then you hold them for a period of time. And when they become overvalued, you consider possibly selling those stocks. A stock with a high PE ratio is considered expensive. A stock with a low PE ratio is considered inexpensive, or we use the word cheap. And a lot of the times when you're watching the financial channels, especially CNBC, most of the guests that they have, this is what they're talking about. They say stocks are cheap, stocks are expensive. I recommend this stock because the multiple is currently lower than the other stocks in that industry group. And so they give a lot of recommendations based on that. And a lot of people listen to that and follow their advice. Sometimes that works, and sometimes it doesn't. Other investors use the PE ratio as a measurement of supply and demand. Instead of seeing this as expensive or cheap, they go, the market is willing to pay more for this stock in relative terms, according to the earnings. That just means that a lot of people want to buy it. Okay, that's a positive sign to me. Where one investor may see prices going high, too far, too fast, and they go, ooh, now we're getting expensive. They want to sell. Another investor may see that as a positive sign, and they may want to continue to buy. So when investors are buying a stock and the price goes up, this often shows an increase in demand. So when investors are selling a stock and the price goes down, this often shows a decrease in demand or an increase in supply. And that's really how the stock market works. It's the forces of supply and demand. If there's a real demand for a stock, prices will go up. If nobody wants the stock and there's a huge supply, prices will go down. So how is the price-earnings ratio calculated? And there's some different ways, and I have a little different twist according to what some of you may follow who are watching this. The PE ratio changes every day, and it's marked to the market by using the closing price for calculation. One of the variables that you put into the PE ratio is the current price. And that changes many times throughout the day. So what they do is after the stock market closes and you have a closing price for that stock, that is used to recalculate the PE ratio. And unless you had a really big move, it's not going to move all that much. The current price is divided by the annual earnings that have already been reported. That's the different part that I use. I'm looking backwards at earnings that have officially been reported. Now, a lot of investors like to look forward, and the stock market likes to look forward, and I have some reasons why I use that, but I don't rely on it as heavily. So we have a thing called the trailing 12 months, or TTM, that's based on GAAP earnings. That's what we use in the calculation. And even though it already happened, it can still tell us lots of useful things. There's also another aspect to be aware of, and that's called the multiples approach. The multiples approach is a valuation method widely used to determine if a stock is expensive. So if you come up with a multiple of 20, that is considered to be an expensive stock, 20 or above. If you have a valuation of 15, anywhere from 19 to 11, 15 being right in the middle, that is considered to be fair value. The stock is Goldilocks at that point. Not too hot, not too cold. Just right. Then if you have a stock with a multiple of 10, that is considered to be cheap, 10 or lower, so 9, 8, 7, 6. Now, one thing to be aware of, there are some very good companies out there that have a very high multiple, and people like that, and they're okay with that. There are other companies that have a very low multiple, and they're not necessarily good investments. There's a lot of other factors that you want to use to make a decision. This is just one aspect. Here's an example. If a stock or index has a current PE ratio of 10, that means an investor is willing to pay $10 per share for $1 per share of earnings. Another example, if the current PE ratio is 20, that means an investor is willing to pay $20 for $1 of earnings. So you can kind of see how there's a difference between the two here. 10 and 15 and 20 are kind of the critical numbers when we calculate things this way, and you'll see what I mean here in just a moment. So let's talk about earnings. Earnings can be TTM, trailing 12 months. This is history. This already happened, and the stock market doesn't look backwards, it looks forwards. But it's real. These numbers that are reported are official. People go to prison if these numbers are not right. So this is one of the reasons I like to rely on them. They have a much greater chance of being real numbers because there's a lot of accountability if something went wrong. The market likes to use forward earnings estimates. This is what is expected in the future, but it's a forecast or a guess. Again, getting back to a lot of the people, the talking heads on the financial channels, they'll come on and what they're giving you is what they think will happen in the future. Are they right? Are they wrong? Who knows? But there's a lot of people out there and a lot of people that work on Wall Street. This is their job, is to crunch all these numbers and come up with what they think the earnings will be in the future. They're not worried so much about what's already happened. They're looking ahead. And some of these people are right and some of these people are wrong. And what ends up happening, especially with the bigger companies, is you'll have multiple analysts all following the same stock, and they come up with all their different figures. And so what they do is they might take an average. They'll put all of those analyst figures together and come up with, okay, this is the median price or this is the average price. But when looking ahead, they really don't know. It's just a guess. Some prefer to use TTM like myself. And again, I use this in a little different way. I'm not using the PE ratio to find investments. I'm looking to see what is the valuation of the stock market right now in comparison to what it's been historically. But others prefer to look at forward estimates. You need to decide, do you want to look backwards at numbers that are real, or do you want to look forward at numbers that are forecasts or guesses? For this discussion, and for what I'm trying to show you in this video, I will use the trailing 12 months, or TTM. For a chart of forward estimates, please go to a very, very excellent website, and I'll leave a link to this below this video. It's yardeni.com. I wanted to use some of the charts in this video from that website, but there's a pretty strong copyright warning with all the information, even though it's free. And so I decided not to. I've contacted the company and I haven't heard back yet, and I wanted to go ahead and record this video because it could take some time for them to get back to me. I believe in using information from other sources if I have their permission. And if I don't have their permission, then I won't. But you can freely go to yardeni.com. There are lots and lots of different files and PDFs that you can look at for free. There's a blog you can follow, and there's some really useful information there. One thing that we can do is make comparisons when we're talking about valuations. How do you know if something is more or less valuable? You have to compare it to other things that are very similar. You don't want to necessarily compare a car with a truck. You want to compare a car with a car and a truck with a truck. The PE ratio is compared to other stocks as well as indexes. Because if you come up with some kind of a number let's say 23 or 8 for your multiple, it's like, well, is that a high number or is that a low number? You have nothing to base it on. What you do is you look at other stocks and other indexes and you see what is the multiple of those other things, and now you have something that you can compare it to. Comparisons can be made between similar companies. So if you have two software companies and both of them produce very similar software, now you have a lot bigger chance of making a good comparison. You can also compare them within an industry group, and I have another video where I talk about the different industry groups, where there's a standardized method for taking all the companies out there and putting them into an industry group so that you can compare some of these companies with each other. And within a sector, the S&P 500 is broken down into 11 sectors, which I also have a video about, and you can compare, is this stock cheap or expensive compared not only to the industry group, but also to the sector. And then you can compare it to an index. And the index that I use is the S&P 500 or SPX. So for this discussion, that's what I will use because I have a program that's completely focused around the S&P 500. Then we have a thing called the multiple, which I've talked about a little bit already. The PE ratio may often be referred to as the multiple. Stock prices will usually be priced at a multiple of the PE ratio. Stocks are usually measured according to 3 different multiples. And here they are. If it's 10 times earnings, that is considered cheap. If it's 15 times earnings, that is called fair price. So it's not too expensive and not too cheap. It's right in that sweet spot. Anytime you get to 20 times earnings or greater, that is considered to be expensive. And here's a chart just to show you. And I'm going to go all the way over to the right-hand side because in the video that I put out before this, I went through the historical values before. So please go back and watch that video. But way over on the right-hand side, we have the current price of the S&P 500 as of the end of the month of July 2021. We're right at 4395.26. If you see the red line right there, that's what the S&P should be if we're using a multiple of 20. You see a little problem there? When I first recorded this video, the red dotted line was even lower. So earnings have been going up as the economy has been opened up again, but they're still way out of line. And I'll show some more information to back that up. If we were to price things at a fair price, not too expensive, not too cheap, the current value should be at 1923. Wait a minute. The S&P is at 43.95. And just to be not too hot or not too cold, we have to be at 1923? Should I get a little concerned now? Yes. Yes, you should. And to be considered cheap, the green dotted line along the bottom, the S&P is at 43.95. We would have to go down to 1202 just to be considered cheap. That's a pretty nasty fall. Even though earnings have come up, they haven't kept up with stock prices. Here's another chart just to show you. What I did, I just took the red line. I forgot all about the blue and the green line because we're way far away from that. And I just took the value of the S&P 500 and I subtracted the value of the red line. And you can see this is going back a long way. We've never been this far away from a valuation point in history. And we certainly have never done that on this chart. Now, the lines in the middle, around 2008, 2009, the whole S&P went negative, and that threw everything all out of whack. That's why you have that really weird spike right in about the middle. Don't worry about that so much. Look way over on the right-hand side where I have it highlighted. Now, if you've been investing for a while, go back and look at the year 2000 and see how far overvalued we were at that point, right before the big bear market. Or where were we in 2007, 2008, right before another bear market? And where are we right now? We're just off the charts as far as overvaluation is concerned, using earnings that have already been reported. Here's another way to look at this. And this is as of the close on July 30th, 2021. To have a multiple of 20, we closed at 4395.26. TTM value should be 2564. The difference is 1831.26. The bottom line here is the S&P 500 would need to decline 41.66% just to get back to being expensive. Then To get back to a fair value, the S&P 500 would have to decline 56.25%, and to be considered cheap again, the S&P 500 would have to decline 70.83%. Now, this isn't meant to scare you because this has been going on for a couple of years now, but it's something that you should be aware of, and then you should take some other things, start to get ready, and when you see things really start to change, then that's when you make your move. Because this can go on for a long period of time, and it may continue to go on after this. These are the same numbers, just showing you on a chart form, where you have the S&P as of the close of the last trading day in July 2021, where it should be to be considered expensive, fair, and cheap. And I update this chart every day. I look at it, not every day, because usually it's at the end of the month, because this goes back a long ways, and these numbers don't change all that often. That's why it usually is about 6 months each time between doing updates of these videos. Now, what about the forward PE ratio? Yes, a lot of people use that, and a lot of people focus on that. And there is a place for doing that, and I have another video that talks about that. But my concern right now is looking more at history and what has already happened, because history does have a tendency to repeat itself and to rhyme with it. We don't really know what's going to happen in the future. So they can come up with any pie-in-the-sky number that they want to. They can always adjust it later, and there's been a lot of adjustments. So the forward PE ratio that was reported in the Wall Street Journal on July 30th, 2021 is 33.75. Do you remember, to be expensive, it has to be 20 or above? So even with forward earnings, and even with them going up, we're still 13.75 points into extreme expensive territory. That means companies are going to have to start earning an awful lot of money and convince the analysts that they're going to earn a lot more money to push that number up. Or the other alternative is stock prices need to come down. The big question is, why haven't they? And I have an answer to that I'll provide here in just a minute. Here's another way to look at this. There's a guy named Robert Shiller. He wrote a book called Irrational Exuberance, which comes from the old Alan Greenspan speech. I would highly recommend that book. It's on one of my recommended reading lists. And I went to his website, and he has a slightly different way of calculating the PE ratio. And I have a video that talks about this. This is as of July 30th, 2021, where you can see way over on the right-hand side, the current PE ratio, according to his calculation, is 38.18. Well, it's like, okay, big deal. But you look at other weird days that have happened in the stock market. Look at where it was on Black Monday. That's the stock market crash of 1987. Look at where it was in 1929. We're above those levels by a considerable amount. Now, this is only one measure, but this is a measure, and a lot of people watch this, and we should pay attention to it as well. The average that Robert Shiller has come up with is down in the left-hand corner. It's 15.85. We are way more than about 2.5 times the average price of what this has been. And look how far back this chart goes. It goes back into the 1870s, possibly even into the 1860s. That's Civil War time, folks. That was a long time ago. So we take the average or the median price over that period of time, and this also suggests that we are very, very overvalued. But this has gone on for a while now. Doesn't mean things are going to change overnight. It's just one of the pieces that will come into the puzzle that when things do finally shift and turn and move down, people will use this as justification for selling. There are other valuation models, and I have other videos out there, and these are as of July 30th, 2021. There's a thing called the yield curve model, and I'm not going to explain any of these right here, but that's just measuring the overall economy. Usually when the yield curve is getting higher and expanding, that shows the economy is expanding. When the yield curve is flattening or going down, it shows a contracting economy. Well, right now, that's fairly valued, but that has to do more with interest rates. Then we have a thing called the Buffett indicator, for those of you that have heard of Warren Buffett, and that is considered to be strongly overvalued as of July 30th, 2021. There's also another one called the S&P 500 mean reversion model. That's also strongly overvalued. And then another model, which I have a video about, is the interest rate model, and that is fairly valued. So looking at this, Stock prices are very overvalued. Interest rates are fairly valued, but look at the minuscule rates you're getting. A lot of the bonds out there, in fact, I think all of the bonds out there, even the government bonds, there might be some corporate bonds that are not doing this, but have you seen inflation lately? We're not even beating inflation. So if you invest in interest rate investments like bonds and you think you're getting a good return, well, look again, because you have to compare that with the inflation rate, which has really spiked up as the economy has opened back up. So what are some conclusions that we can make from this whole thing that we just got done talking about? The S&P 500 is overvalued and has been since about 2019. I just went back and looked at the chart and I saw when did that red line really start to spike up? And it was about in 2019. This is before the whole pandemic. Extreme overvaluation has persisted and grown since the beginning of the COVID-19 pandemic outbreak. Companies were shut down. We had the COVID plunge, and then prices just V-shaped right up out of that, and for some reason have been going higher. Now, I know the reasons behind that, and I'll talk about it here in just a minute. Stocks and indexes can remain valued at current levels, whether that's cheap, fair, or expensive, for lengthy time periods. This can go on for years, and it already has gone on for years, and it may go on longer. That's why we don't want to use just this tool to make our decisions. We want it to be one tool in many that we use. Other indicators should be consulted to observe signs of weakness and a possible change in trend. In this case, the trend change from up to down. We've been looking at this now. I've been looking at this for over 2 years, and it's been saying pretty much the same thing, but it's just gotten worse and worse and worse. It's like the balloon is getting bigger and bigger and bigger. Is it going to pop at some point? Probably. But how long is that going to take? A lot of people thought it was going to happen by now. A lot of people thought it was going to happen a year ago. A lot of people thought it was going to happen back in 2019. And it really didn't with the severity that usually this type of thing warrants. But it probably will happen at some point in the future. You need to be prepared and keep on top of this. Doesn't mean you freak out right now, but this is just something to keep in the back of your mind and use for justifying adjusting your positions. Regardless of the conditions, price must be respected and followed. If price is going up, we got to follow that, whether it makes sense or not. And that's where a lot of other analysts really make mistakes. Yeah, I'm predicting a 50% decline in the S&P 500 in the next 3 months. Well, yeah, you could based on what you see. But then you end up looking like a complete fool when that doesn't happen and nobody listens to you. And so then when you really have something to say that is of value, it's like crying wolf. Nobody's going to listen to you. That's why I say, do you need to freak out now? No, but you also need to implement other tools to make your decisions. If price continues to go up, we have to go with that, even if it doesn't make sense. This is why the stock market has gone up through the whole lockdown and continues to go up, for the most part, as the economy starts to open back up. The massive amounts of liquidity from the Fed and the stimulus from Congress that has been pumped into the economy has helped keep prices moving higher. Now, are there going to be more stimulus packages in the future? The Fed is still pumping liquidity into the economy. They're buying government bonds and corporate bonds, $120 billion each month. That's helping keep interest rates down. And interest rates are so low that people are then putting their money over into the stock market. And people just getting these checks from the government, well, some people take that money and put it into the stock market. You have all these millions of people all lining up to buy at the same time. That pushes prices higher. And the government has a real incentive to keep prices higher. Also remember that a large part of the current administration's advisory team comes right from Wall Street. So it's in their best interest to do the things to keep the market from falling. Because if the market falls, a lot of those people are going to lose a lot of money, and they may pretend to care about you, but first and foremost, they care about themselves. So thank you very much for taking the time to watch this video. I really appreciate that. If desired, please click the like or dislike button below. Please leave any comments, either positive or negative. Also, consider subscribing to this channel as I try to have it grow. That'll really help things out. Please access the free workshop that I talked about at the beginning of this video. And I also have a blog. I'm getting a little behind as I record this on my articles because I've been spending so much time doing videos. But there is a blog at spxinvestingblog.com where I pretty much write about the same things I talk about in the videos, but my writing style and my talking style are a lot different from each other. And I'll let you determine which one's better. So thank you very much, and I'll talk to you in the next video.